How many investment principles did you learn in school? In today's video, we're going to be covering 11 Peter Lynch investment principles that were never shared in high school or school in general. When you know, and if you're familiar with Peter Lynch, he is the Fidelity Magellan Fund Manager and one of the most successful investors in history, posting a 29% annualized return over 13 years, which is absolutely extraordinary. I mean, right up there ranking with those Warren Buffett of the world that are doing incredibly well year over year over year. Now, these concepts are rooted in a couple different things: observation, curiosity, and of course, common sense, instead of really the advanced financial theories that they're taught. And of course, I have a degree and I have an advanced degree as well. And a lot of these things pretty basic, but definitely being able to understand. The first one, don't fear corrections. People are very unsettled about the market, and the market is in a very emotional place when it shouldn't be. When we think about a 10% correction, most people will just go ahead and panic sell. Fear will take over and they will liquidate portfolios, meaning they are losing a ton of money, especially thinking back a couple years ago where the market was down, 20, 22, 25%, depending what you're invested in. That is the point that you have to turn it into a really big opportunity. If you have money sitting in the sideline, if you're dollar cost averaging, when that market keeps going red and continues to decline, that is the time you are getting a discounted price on everything you're buying. For me personally, this is ETFs, and I buy ETFs and only ETFs, not individualized stocks. It is fundamental to understand you cannot let the emotional side take over, that it has to be rooted in logic. And when you think about, again, a 20% discount on those S&P 500 funds, that is a pretty good starting point and a pretty good rebate that you're getting right off the top. Now, second one we look at, avoiding the hype. When you think about hot stocks, everyone talks about them. They go up because people are putting money in it. A lot of times it's too late. If everyone is already talking about it, if it's in the news, if it's already plastered all over social media, chances are you might have already missed the train and the inflation is already there. The price has already increased a ton, which is what we normally see. We've seen it with Tesla. We've seen it with Nvidia. We've seen it with a lot. When your neighbors are talking about it, when everyone's talking about it, when Bitcoin is all over the news, guess what? That's usually when Bitcoin is doing incredibly well. Now, of course, staying curious. This is one of the reasons which drove me to YouTube and the financial education piece. Staying curious about what investors are doing, what your financial literacy and education looks like. What does it look like? What do you want it to be? What does a company do? When you're investing in something, you have to know exactly what it is. When you think about the crazy amount of really research that Warren Buffett did, it really makes a difference. And looking at opportunities that some people might miss, even looking at some companies that you're using in your day-to-day life. When you think about what you drink, what you eat, where you shop, everything you do, could it be a very good investment opportunity? And staying curious and looking at those opportunities. Now, the fourth one we get into is being patient. When it comes to generating wealth and when it comes to paying off debt, when it comes to debt mitigation, even accumulation of debt, it doesn't happen overnight. It comes with an extended amount of time. When you look at the great investors, you're talking, 20, 30, 40 years. Even thinking again of Warren Buffett, 65 plus, is when we started seeing a really big increase in the portfolio. Even thinking, of Peter Lynch and his investment strategy, if you're looking at a 24% compounding interest year over year over year for 13 consecutive years of growth, that is pretty incredible. Even when we talk about investing in general, you're talking a 5-year plus really runway to get into the market, to stay in the market. And of course, it is not about timing the market. That is something that we have stressed for an incredible amount of time. Trying to put money in at a very specific time is near impossible, even for the best investors in the planet. It is about the time that you spent in the market versus trying to time the market. Now, of course, invest in what you know. This is one of my absolute biggest pet peeves. Invest in companies, in industries, in cryptocurrency, in what you know. If you do not understand how Bitcoin works, how really blockchain technology works, I do not advise investing in it at all. When you start thinking of equity, gold, real estate, mutual funds, fixed deposits, CDs, you have to understand and know exactly what products and services that you're going into, what trends are around those, and are you getting the best product that you could possibly get? When you think of high yield savings accounts, are you getting something that is FDIC insured? Are you getting the best rate? Are there better products out there? If you do your research and know exactly what you're putting your money into, it is going to make a difference when it comes to your financial well-being. Now, next one we look at is ignoring the noise. This, of course, is something that is very hard to do if you're tied to social media. Me personally, there is a ton of YouTube content that I consume. And of course, I know reliable sources versus really unreliable sources. But when you start thinking of long-term performance, the market is going to have ups and downs. There are going to be news articles where Boeing is doing, not so well, or looking at Spirit Airline, declaring bankruptcy. All of the noise that is out there, it is kind of crazy because if you really silence the noise and look at the fundamentals of the company, even now, thinking of a company like Nvidia, where everybody is saying, oh, the price to earnings ratio is too high, they're really overvalued. Well, breaking it down, it is going to be an up and down. There are going to be up days, there are going to be down days. And I know a lot of times with these high profile companies, these stocks, they do make the news. Even thinking of the HD, right now it is down quite a bit. The yield is still doing really well, but overall the ETF itself has come down quite a bit. And of course, that gives me a really solid opportunity to put a lot more money into it. Now, going back to philosophy for our next one, look at boring companies. This is something that, of course, Warren Buffett really set the precedence for. When you look at Apple, when you look at, Coca-Cola, when you look at Bank of America, when you look at these really large companies that really never make the news, I don't even know the last time Coca-Cola was in the news for anything revolutionary, anything really game-changing. They have done it tried and true for so many years. You don't even hear about them anymore. And things, of course, that are part of your everyday fundamental. This could be waste management. This could be Coca-Cola. If you're going to McDonald's, if you're going out to eat, chances are they're serving Coca-Cola. It is a brand that is known globally, worldwide. They have the opportunity. A lot of people do utility providers when you think of like Consumers Energy. Those companies are going to be around because they provide the infrastructure for the entire country, which means those companies cannot and will not go anywhere. Imagine companies like Verizon, AT&T, things of that nature that control 80-90% of the market share when it comes to communications. They're not going anywhere. They're going to be the cell phone providers for the ups and downs, regardless of what's going on. Now, when we start thinking of stock prices, look at the story is in the stock price. This can make a really big difference. And of course, for this, I challenge you with panning out to see what the stock says and really what the story says. Is it one that moves, with the Federal Reserve? Is it growth? Is it innovation? What kind of stock are you looking at? What kind of ETF are you looking at? And is the company going to do well? When you're looking at someone like Blockbuster, that of course Netflix wanted to get in, Netflix pitched to Blockbuster. Unfortunately, right now, Blockbuster is no longer with us. I believe there's one store left, but Netflix, of course, is absolutely booming. Is it going to keep up with technology? Is the momentum going to be there? Are they working on the research and development, the cutting edge technology that is going to bring us into the future generations? The story is really important before you start breaking down the numbers of knowing what these companies are going to do. And of course, that brings the risk tolerance. This is the part where my exchange traded funds, my ETFs really come in. To one person, investing might be super comfortable, even if you're just being, in really basic stocks and bonds. Some people might want a lot more risk or exposure to cryptocurrency, a lot more risk. You have to determine and you have to figure this out long before you start investing. When you start putting it into something that is highly volatile, where you might see a 5, 10, 15, 20% dip in a single day, 100% increase over an entire year, or you know what, an 80% decrease, you have to know exactly what your investment choices are and how much of the portfolio do you want to allocate. Me personally, when I look at the growth function, that is about 40 to 50% of my portfolio. I'm still young enough. If we still do see a down market for numerous years, I still have the ability to recover. I do like having not only addition to that growth fund is having something that is solid like an S&P fund, and then of course one that is generating income. That income goes back into the portfolio and it is a cyclical business right there. Now, of course, you could focus on earnings growth. This is one that really Peter Lynch talks about, is looking at the earnings of a company. Setting earnings and setting growth are a very strong gauge for companies that are successful and companies that are very healthy. Look above and beyond that price to earnings ratio to see exactly where companies are and what companies are poised for the future. Are they borrowing too much money to stay afloat? There's a lot of companies when their earnings growth really beat the expectations, it makes a big difference. And usually you see a 5 to 10% increase in those specific companies when it comes to those really portfolios. And for me, the final one is keeping it simple. This is not overcomplicating those investment strategies. Me personally, I have a solid portfolio that I built. It does include a little bit of cryptocurrency. Again, we have the 3 ETF portfolio, but overall, investors really do lose money when they overthink the investment strategy or they're investing in things that they don't understand. So his advice specifically, stick to the basics. If I can take and put money dollar cost averaging every 2 weeks, we're investing in the market over time, it's going to work. And it does work. The stock market, even if it has down years, when it has up years, when you start looking at the median, when you start actually focusing out a little bit, looking at, let's say, 5 to 10 years at a time, the stock market has yielded about a 10% return or 10% growth year over year over year, which is kind of crazy to think how successful it can be if you're just consistently putting money into it. Simplicity is sometimes the strongest thing, and time is the one that you have on your side. The eighth wonder of the world, which is compounding interest. Now, guys, that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.